Hello, everyone. My name is Mike Vanoy with Assure. I want to thank you for joining today's webinar. I see a bunch of people still climbing on. The number's ticking up fast, so I'm going to give it about 60 seconds. So we'll go ahead and get started. Wanted to let you know you're in the right place. Hello, everyone. My name is Mike Vanoy with Assure, and thank you for joining today's podcast webinar, Top 5 Myths About Fully Insured versus Self-Insured. First of all, let me introduce my guest today, Matt Williamson, who's the Managing Partner of Employee Benefits and PEO Services at the Insurance Office of America. And as Matt and I were talking in preparation for today's discussion, it just kind of came to the realization that this whole world of insurance and benefits for going on, since 2008 with the Affordable Care Act, there's so much change in this benefit world and attempts to bend the cost curve. And what I think has maybe been hidden under the scene here is what opportunities really do still exist for small and mid-sized businesses, specifically as it relates to being self-insured, right? Where in the past this was kind of a known thing for really big companies, that there was you think about your risk pool and you got a big group of employees, and hey, we can do this more cost effectively by self-insuring. But largely this has kind of gone unnoticed in the small business world. And so that's really today's discussion. I think Matt and I want to kind of set the stage and talk about what self-insured even means. But for those who do know what it means, there's a lot of myths that I think most people think that this is a big business play or it's too risky of a play. We couldn't handle this on a cash flow basis. Matt's going to help us kind of put a bunch of those concepts to bed. So with that, I'm going to welcome Matt. And maybe before we jump into the 5 myths, let's just talk about what does it actually mean to be self-insured. And so, Matt, maybe if you could tee us up here, when I think about all the nameless faces of a big risk pool, right? So you got a big insurance carrier or a really big company with thousands of employees. You have somebody who has a heart attack, somebody has cancer. Those are expensive claims. But you also got hundreds or thousands of really healthy people that kind of offset all that. But what does it mean for a small employer who does not have this giant risk pool, and a heart attack could really, if done wrong, could devastate a business? Kind of walk us through this continuum that didn't necessarily exist even just a few years ago.
No problem, Mike. Thanks so much for having me on. I greatly appreciate it. We created this healthcare cost continuum based on the fact that a lot of groups are fully insured right now, and they don't understand how they can, first off, get data, because when you're fully insured, especially in the mid-market, the small market, it's impossible to get data on your group. So we started on the left-hand side, and the fully insured means basically that you pay your premiums, you get your renewal, you pray that it's a single-digit renewal, but where it comes in, the plans are all basically made for you. You can choose between plans, and you get your renewal, and you hope it's single digits, but most of the time it's not. It starts with trend, which is usually 12 to 14% per carrier, and there are, through the ACA, there are some additional percentages built in there. But the fully insured market is you pay your premiums, they pay the claims. When your renewal comes up, you get your number. If you don't like it, people start moving deductibles around and try to get creative. And that's how the fully insured market works. Obviously, everybody, if you're under a certain threshold, a lot of states throughout the United States have basically filed state filed rates, so you can't even move them. And all you do is choose a broker based on the fact that you have a good relationship and they give you good service. Well, the next level, the level funding with the BUCA stand for obviously the Blue Crosses, United, Cignas, Aetnas, and Humanas of the world. That's the acronym BUCA. So that's all the big players that are out there. Now there are other regional carriers that can provide great service, but that's kind of what they use for the leading groups. The level funding now is the ability to have a product that is considered self-funding, but it gives you the ability to, it looks just like a fully insured product, but it does fall under the regulations of self-funding. But what happens is, if you have, I'll give you an example. If you have a $400 rate on level funding, 100 of it goes towards the administration, which you can't recoup. However, 300 will go to the claims bucket. At the end of the year, if you have a good year, you can have the ability to receive half or 75% of that claims bucket, and that's called level funding. And Cigna and Humana are primarily two of the big carriers that introduced that. So, and now when you start going into partially self-funding, this is where you're starting to introduce more of, you're getting more ability to assume risk. And this is wherever the conversation starts, where the stop loss comes into play. And what the stop loss is, as you alluded to, Mike, previously, about a large claim, a heart condition, a cancer, preemie baby, something of that nature that's really going to move the needle on your claims. You establish the stop loss so that one incident doesn't go over a certain threshold, usually around 25,000 on the smaller groups. And so that's why you don't get dinged higher than that towards your claims. Now, partially self-funding with a TPA, which is a third-party administrator using Blue Cross or United or Cigna's network, is another way in which you can really start moving the needle. So what you would do is hire a third-party administrator that would do all the claims adjudication, but now you have more ability to move the fixed cost as far as administration, some of the different products that they have within. Maybe if you do have a cancer situation, the TPA might say, hey, look, we have these nurses on staff. They reach out to people full time, that they'll help them with their cancer situation, make sure they're taking their medications. They do a lot more follow-up. Now, I'm not saying all the BUCAs don't do that, because they do, but sometimes with a TPA, it's more of a personal level. And what they do is you can lease or rent, and there's a network access fee that's built into the TPA for Cigna or Aetna or any of the Anthem networks. You can do that. So now you get into, we're getting in larger groups, and this all kind of is mid-market to moving to larger groups where you have the law of large numbers. And now you have the network with the rental network we discussed with the BUCAs. And then you have medical management vendors for guidance with steerage to lower cost or high quality of service. For example, I'm in Orlando. We have two tremendous networks down here that both do a fantastic job. We have the ability to negotiate with one of these networks, and we have steerage. We call it an accelerated network, or, obviously it means that we have steerage to push them towards that network because we're getting better claim prices. And what we use is, we can use a wrap network, which would be one of the BUCAs or something else in addition. So what you would do is have a plan that would steer people to a narrow network or accelerated network or whatever title you want to call it. And then you have a second plan, maybe that has higher deductibles and higher out of pocket, that you can still go to anybody you wanted within the national carrier. And then finally, you replace the networks with reference-based pricing. It's a solution now for centers of excellence. And what happens in these models is there's many providers out there that have gone and done all the research on these centers of excellence all over the country. Obviously, Moffitt, Shands, Cleveland Clinic. These are just a few of them, that's off the top of my head. But these centers of excellence are in the network, and then you have a tremendous steerage towards these centers of excellence, and then you have it all wrapped around the fact that you will be working with these centers to keep claims down. So that's kind of a wordy, lengthy walkthrough, but hopefully you can understand.
Yeah, Matt, so a couple things jump out to me. One is, it's not a binary thing like it used to be, right? It used to be, I was fully insured and I went with the big carriers, or an unknown carrier of your choice, or I was self-insured. There wasn't all these gradient layers in between. Walk us through maybe the last kind of decade about how that, how that's kind of evolved over time. With it, you don't have to re-explain each of the buckets, but how has this changed? And so, because I think it kind of underpins why a lot of us in the market, the small business market particularly, don't know about it.
So, and that's a great remark right there, Mike, because in the last 10 years, we have seen things, and I've been in the business, just take a step back. I've been in the business 28, and I've been on the broker side for 15, but I've been in insurance for 28 years. But if everybody recalls back when the PPOs came out and really discounted medical pricing, that you had to use a network, that really changed a lot of the mentality, because now you are saying to folks, okay, look, you use this network, you're going to save a tremendous amount of money. You're going to have these distinct co-pays for, you go to the hospital, it's $200. You go to the urgent care, it's $25. I mean, the co-pays were extremely low. So that came out and really changed the game, because everything was more of a PPO, go wherever you want, and it wasn't working. And then all of a sudden this HMO came out, and it was like a radical change, because now everybody's saying, oh my goodness, I have to use this low network. But through education, we changed the mindset of folks, because it made sense, because you saved on premium dollars. Well, claims caught up, and those networks started charging more. So as you look at the wheel, things started changing on that. So then we started getting into health savings accounts, and then we really started looking at, which is kind of like self-insuring, because it's a lot more education. So now you had $1 programs, which is kind of like basically you're insuring yourself for knowledge. And now you're forcing folks that if they have to get an MRI, they're calling around, because they don't want to get dinged if it's $1,500 whenever they can get it for $300 by just making a few phone calls and having a little price war between the facilities. And everybody knows if you go to the hospital, it's going to be a lot more. So that kind of started really educating. And along those same lines, then we started having companies come out with level funding, and the TPAs really started making a move. And it's a great thing, because it created competition. So then a lot of the BUCAs that we refer to, obviously the acronym, started saying, hey, look, we need to play ball with these guys, these TPAs, because we can still make money on the network access, since we already have it available, instead of just selling our product. So that's kind of how it worked. But now you see recently the level funding strategy is really starting to take hold. And this strategy can go down to groups as low as 10, and realistically, the sale on it is, why would you not take a chance if it looks just like a fully insured product, but you have the opportunity to get money back? So it's almost like a dividend program on the workers' comp, whereas you have a great year and you get money back for having a productive year. So if you are able to manage and educate your employees, and when it's on a level funding, you're able to get all the data too, which you can never get whenever you're fully insured. So I hope that kind of helps us kind of a.
Yeah, no, man, I think that helps a ton. It helps me too. So I think about, I know it's more nuanced than this, but I think about, experienced entrepreneurs and business owners, executives who have been doing this for, doing their thing for quite a while. They most, I would think, fall in the category of, I know what self-insured means, but think it was for big companies, without realizing this level funding and this partially funding alternatives that have emerged, I think, unfortunately, relatively silently. And then there's the other bucket, I think, that is, I'm a brand new entrepreneur. I've started a company, and it's because I'm really, really good at building, this widget or providing a certain service, and just didn't even know such a thing existed. There's learning about insurance. So either way, to me, this is a really helpful foundation. So anything you want to add to just what is self-insurance before we kind of move on and kind of address these myths? Because I think the myths are important for everyone to understand wherever you are, brand new to insurance versus you're a seasoned pro, experienced entrepreneur. Anything you'd want to add?
The only thing that I'd like to add is just maybe through the reform, the filings are a little bit different with each. So, but it's still, once you hit certain thresholds and you're working with somebody who does a good job, there's a calendar that you know when things are coming up, or on the self-insurance side, it's the PP Corey fees, and then on the other side, it's mostly just the ACA, fees that you're trying to, and it hits that threshold over 50 employees. But if you're working with somebody who's very valuable, the compliance aspect of all of these are just extremely important, because the last thing you want to do is have the ability to get fined. But that's just primarily the little nuance. But in reality, the fees on the self-funded side are less than the fully insured side.
Yeah, it's interesting you say, I think most of us know that, the ACA has this 50 employee threshold, and through a lot of HR legislation, coming from our world, at Assure, we think, payroll, we think HR and compliance. There's a lot of HR legislation that has this 50 employee kind of a marker. I think the real opportunity here is for these firms, 10 employees and up, to have an opportunity to really meaningfully cut benefit expenses is so cool. So, all right, with that, let's go ahead and jump in and talk about these top 5 myths. So the first one, and you kind of alluded to it, but I think there's this perception, and I think it used to be right, that self-insuring is just simply too risky. If I've got 10 employees and one of them has a heart attack, those claims are going to crush me, therefore I can't do it. But you put a little more detail around that explanation you gave earlier of why that doesn't have to be the case.
Okay, no worries. So with the smaller to mid market, you're still going into a pooled group. So even though you are looking at self-funding and you're doing it on a partial basis, you're still in a large group, which does protect you. And there is stop loss coverage built in. So you would never be dinged for a tremendous amount, because there is a stop loss, and it's usually 27.5 or 25,000. You will never have a claim over that. And that's part of the administrative fees that you pay, is the purchase of the stop loss coverage. So that's one of the things that a lot of folks say, oh my goodness, if I have a tremendous cancer claim, I'm gonna, I have 200 employees, I'm gonna be spending all this money out of pocket. This is going to be drastic. Well, no, as long as you structure it correctly and you're able to purchase the stop loss, you will always have protection.
So for that young entrepreneur, maybe not young, but a new entrepreneur starting out in business, they're just learning about insurance. A way to think about it, the stop losses, maybe it's almost like, hey, this is insurance on your insurance, right? The insurance is for your employees to provide health care. And then it's a layer on top of that insurance policy to make sure that you're not going to pay too much in a claim. You're not going to, just like your employees wouldn't pay the full cost of their heart attack, they're going to have their deductibles and their max out of pockets. Same for you in paying claims, right?
Correct. It's insurance on your insurance.
So who pays? So I guess talk us through this concept of the standard specific deductible. What is that?
So you're talking about just a deductible. So the 3 things, let's even take a step back further. We'll do one-on-one. The things that drive the cost of a medical plan for an employee and an employer, the 3 main drivers are the deductible, the co-insurance, and the out-of-pocket. So, and the way those work is if you have a large claim, like let's say it's $10,000 and you have a $1,000 deductible, the deductible comes off the bat first. So your remaining $9,000, if you have 10% co-insurance, you'd pay 10%. The employee would pay 10% on the $9,000 remaining. So they would have a $1,900 would go to their out-of-pocket. Those are the 3 drivers. So, I mean, obviously there's co-pays for everything else. And the other thing about self-funding is you have the ability within a program to fluctuate those co-pays. So if something doesn't, like, let's say, I'll give you an example. So we had a construction company, and we had a very high Hispanic population. And for some reason, we noticed that like 400 of these employees were going to the emergency room all of a sudden. And we were like, why are they going to the emergency room for everything? Well, it turned out one of the best doctors in the area that was Hispanic move to the emergency room. So they therefore moved to the emergency room. So we said, okay, so we had to do some education and we did that. But what I'm in this, the reason I brought that example is you can fluctuate and say, hey, look, we want to drive people to the urgent care. We're going to make that copay $50 and we're going to put $500 for the emergency room. So people know we want them to use the urgent care. And we will also educate them as well. So you can do different things like that within a program on the self-funding space.
So talk us through, man, who's paying the bills after the deductible is met in this case?
So once your out-of-pocket is met, the insurance company picks up the total cost for the year. Your deductibles and your out-of-pocket run on a calendar year basis 9 out of 10 times. Now you can have a policy year, but most people run them on January to December. So you run them on a calendar year. It's just easier for tracking, especially with a health savings account. But I mean, I do have clients that they would rather, their fiscal year runs in July, so they'd rather do a policy year. So yeah, it's interesting what people choose, but that's how it works.
So maybe talk us through, and if this is the right place, how does FSA, HSA play into this, in a small business entrepreneur strategy for insurance?
So a lot of people get confused with an HSA or an FSA. So the FSA is a flexible spending account. Anybody can have that on any program. It used to be the account that's the use it or lose it, but now you do have the ability to roll over $500 if you fill out the correct paperwork that's remaining on your program. The HSA, you have to have a high deductible plan attached to it. So when you have a high deductible plan, HSA qualified, there's basically two components. You've got the health plan component and you've got the banking component. Now you don't have to open up the banking component. You can just do the health savings account, the high deductible plan, and work it like a regular plan. But if you choose to use the banking component, you can put proceeds in that pre-tax, which is a tremendous savings. And you'd have to use it, you could use it for dental, vision, medical, anything that you choose like that. So it's a great tool. And if you choose that you don't even want to use a debit card, which comes attached to it, you can, it rolls over. But I mean, it's an interest-bearing account. It's very low. It's like 0.025. So it doesn't do a lot of interest. And basically the rules that govern the HSA banking portion are similar to those of a 401k. So if you went out and bought a TV and you were audited, you would be taxed accordingly based on whatever tax bracket you're in. So the HSA is a great component, but the problem with the HSA now is folks used to choose the HSA plan alongside the copay plan because they could take the difference in the HSA from the copay plan and just dump it into the HSA. Well, nowadays the programs are almost the same. And the HSA, from my perspective, really benefits those that have the liquidity or those that are very ill, that they know they're going to blow through it and everything's covered at 100% after their maximum out of pocket is hit.
Got it. And so, all the more reason to, when you're self-insured, to understand your data and your claim structure, right? Versus
Correct.
Wind all that, right? All right. So we could keep talking about this one because this is, I think, this whole risk pool notion and in the stop loss is kind of the foundation of self-insurance. But looking at the clock, let's move on to myth number 2. And obviously these are related, right? So
they are related.
I got a healthy group. Somebody has a heart attack, somebody has a cancer diagnosis. All of a sudden, we talk about it from a risk perspective, and I think from a premium, the downstream premium impact, but upstream of that, there's scary cash flow implications. So it's kind of talk us through that.
So the nice thing about the way self-funding has moved in the past, as we'll say 10 years, is that it has become more predictable. But a lot of people think just because it's self-funding, automatically they assume it's unpredictable because they assume that if you have a big claim, you're going to have to dump money into the bucket. Now, in a large case scenario, they do have groups that have a very high threshold for their stop loss. Previously, we said it was 25,000. We have some groups that have 125,000, 175,000 because they're large, and we're able to fund the claims bucket, we'll say, quotes, the claims bucket fully, that they can, if somebody does hit that large deductible on the stop loss, then we can fund it. So, but on the smaller stuff, it's not as palatable, and that's why you do have the threshold of the level funded product instead of the fully insured product. So cash flow, this myth is very alive, but now with the level funding, it makes it kind of obsolete.
And then Matt, what's the difference between level funding and self-funding?
The level funding is more of a safe harbor, dipping your toe into the self-funding world, whereas it looks just like a fully insured product, but you're actually self-funding a portion of it, and you have the ability to get money back at the end of the year.
So that behaves a little bit like maybe workers' comp does it?
Yeah, it's just like a dividend program on workers' comp, exactly. It's
All
a
right.
good way to learn and understand and start collecting data and know the health of your population, because it does provide the data necessary to do that.
So is it safe to say the smaller risk pool that you have, you can level fund to get a more predictable cash flow stream, but to maximize the savings, you'd want to pay on actuals, not estimates. Is that a good way to think about it?
That's kind of a true statement, but the nice thing also, when you're a smaller group and you're on level funding, you do get monthly claims analysis that allow you to know how you're trending and what's going on. And usually on the smaller companies, people know whenever somebody's gone to the hospital or they had a procedure or something anyway, so they know it's going to hit. So, but it allows you to start seeing if you're in deficit or not.
So what happens if you have a tough year for claims? You got a couple of key employees with a couple of employees that have some significant health issues. I mean, could you start out with level funding and still have to be in a position where you gotta add to the fund, so to speak?
No, that's a great question, because it just like you do whenever you're fully insured, you get your renewal, and luckily you have a large group around you that helps protect you. So it's the exact same as just fully insured. It looks the same.
That's awesome. Okay. All right. I'm going to move on to myth number 3 here. I think there's this, I've heard the business owners talk about this concept of kind of there's no going back, like this is some tipping point, like, okay, Matt's doing a good job putting me at ease about myth number 1 and 2, that, it's not as risky and it's not going to hit my cash flows, but that is a thought. But if I do this, there's no going back, because I could get stuck with claims that I'm now stuck in this world forever. But isn't that even a true statement? And if it is or isn't, walk us through the evolution of that story.
No, it's not a true statement. Let's say that you've got over 50 employees and you just have some severe claims that are ongoing. You're like, look, we're bleeding. We need to go back to fully insured for whatever reason. Or let's say this. Let's say we go to market on your behalf and the fully insured quotes come back extremely competitive, and it's going to save the organization a lot of money. That has happened. And they say, you know what? We're going to go back to fully insured. Absolutely, you can. But there's a misnomer that people say, okay, well, what if these large claims are still ongoing when we transfer over? Well, there's what's called run out. It's usually 6 months after you term your policy on the self-funded side, and it gives you more of a long period for those claims to run out, and then the fully insured would pick them up.
So I don't want to make any claims, so this is not to be a sales pitch for Assure or a sales pitch for your firm. We'll give share contact information at the end, but just kind of ballpark. So appreciate you kind of level setting expectations for what is factually out there, but what kind of expectations do most small businesses see or achieve when making these switches? What kind of percent of those actually do want to end up, for whatever reason, want to go back to fully insured?
So last year, I probably had and I'll just use my numbers, I probably had 25 groups that were small to mid-market that were level funded. We'll use that number, 25 groups. I had 2 that went back to fully insured that had terrible claim years out of 25. Out of the 25, I had probably 16 get money back, which is a huge number. And it might not have been a ton of money, but I had one group that was 125 receive $56,000 back.
Wow. Okay. All right. So as we think about risk of making a move, not only is this not a tipping point of no return, you can go back, walk it back if you want. Just, and this is anecdotal because 25 is not a huge sample set I get, but over half of those saw meaningful savings in their first year from that then.
Absolutely.
Yeah, and so just to repeat, yeah, for our audience, our mission with these podcasts and these webinars is to help provide education for small businesses to save money, to make money, to grow. So that's it. And so if this is an avenue that works, you know, if you want to call Matt, awesome. If you want to work with your in current carriers, awesome. We just want to help people grow. So to me, that's huge. Can you just talk maybe more about what it looks like and how that process would work? About, you know, because as we talked in the beginning, this isn't binary. I'm fully insured versus self-insured. You know, taking 2 steps forward, maybe 1 step back. What does it look like changing if people want to, maybe they stuck a toe in, they want to go deeper. If they stuck 3 toes in and then they want to come,
I got you.
they don't want to come.
Yeah, so
Yeah.
it's the process is just how everybody does it today. It's just finding somebody you're comfortable with that can provide you the data and educate you as you go on this journey. I would suggest working with somebody who has a strategy that's not 12 months, that's 2 to 3 years, because the evolution of the company does ever change, and folks' health change. But you want to be with somebody who has the ability to pivot quickly and allow your employees to become educated throughout the process, because it's going to change. So really a change management strategy is something that everybody should talk about, because when your healthcare is the number 2 line item for a company as far as expenses, next to payroll. I mean, there has to be something that changes. You know, there has to be, because the cost and just dealing with these astronomical numbers is ridiculous. And it's like, sometimes I feel like the Grim Reaper walking into places, but we always find a solution. And it's just, you have to educate and just work together as a team. But it takes, when you dip your toe in, you know that you have to have somebody who's going to be able to provide the data to you, but also be able to understand the data. And then when you do that and you feel educated and comfortable and also confident that the time's right, that's whenever you make the move. And honestly, you have to be a certain size to really want to move forward to get to where you're using the BUCAs and the TPAs. But when you hit that and you are comfortable with it, you really have the ability to move the risk needle in your favor. So it's just finding somebody who's educated that can help you through that journey.
Hey, Matt, you've mentioned a few times now about, you know, the data. And so it's important to have the data. I mean, being in the space, I know what that means. For those who are new to insurance, the entrepreneur who is a brilliant code science person, and she just built an amazing SaaS product, is taken to market, and now has to provide benefits to her employees for the first time. What does that mean, the data, as it relates to healthcare and benefits?
The data is the driver of the cost. So upon looking at information that's provided, even on the level funding, let's start with the smallest groups. When we receive the information, you always receive the large claimants, how much those are, and then a lot of times the carriers will project out what they think is the total amount that's going to go towards the claims at some point over its lifetime. But then when you start getting into more, like Cigna has a great report, and it has all the pharmacy on there, all the prescriptions folks are taking. What are, how many times have folks gone for their wellness visits, how many times they go into the doctor, how many times they go to urgent care versus the emergency room, how are things trending from the prescription percentages on what are they using for generic, how often are they having home delivery versus going and picking it up. I mean, this is all data that's in there that you can build around your population to see what is important and how can you move the needle to keep your premiums down and design a plan that's going to be beneficial to all of your folks that work for your organization.
Yeah, perfect. You know, here's the big thing that kind of just jumps out to me. This whole point of no return, is that there is no such thing anymore, right?
Nope. No, it's gone.
To me, that's almost like the biggest takeaway. It's kind of like I got a light bulb moment for me in this conversation, is that, hey, not only is it not a point of no return, that if you're not pushing the envelope and trying something new every renewal season or year, at least exploring the options, even if you don't make a change, then you're spending too much money, right?
It's wise to shop every year, and it's wise to be on the front line of technology and the different things that are available, because it's ever changing in each community and each state and each region. You need somebody who's on the front line and that totally understands and can pivot quickly.
Yeah, cool. All right, let's move to myth number 4 here. So, I think there are concerns, and maybe in some pockets this is a legitimate thing, but hey, I don't want to self-insure because I'm not going to be with one of the big bukas, and I'm not going to stick my employees with some unknown carrier, and therefore it affects my brand as an employer because they think I'm cheap and I don't have their back. Talk us through that.
So a lot of times we see this, and this is all on the education front end. And we see this a lot of times whenever you use a third-party administrator. So there's one here local, preferred benefit administrators. So preferred benefit administrators is like on the card, but really we're using the Cigna network. So a lot of the providers will say, I've never heard of preferred benefit administrators. Well, it's not, it's the Cigna network. Preferred benefit administrators is simply the folks that are processing the claims through the network. They go through the network for the discounts. So what the providers would do is send the claims to preferred, to TPA, and then they would receive the discounts and they would help do the adjudication of that. So a lot of times what we've done recently is allowed the carrier to be more visible than the TPA, and that's changed a lot of the misnomer about that because they assume the TPA is the insurance company, and it really is not. And that's the confusion. But it's all part of the education process, Mike.
And Matt, when you say the education process, I'm assuming you're talking about educating your employees about what they have, right?
About, the company's employees, about the programs, how they work, videos, conferencing. I mean, a lot of times, I grew up north, and we pay for, you want to understand it, and I take that personally when I work with the organizations I do. And one of the big things we do is I hate to see, a man or a woman come up to me and they're like, I have no idea what I've got. And I sit down with them, and my team sits down with them, and it's like, okay, here's what you got. Here's how it works. If this happens, you need to do this. And insurance is not the employer's headache. It's the broker and the carriers. It's for somebody to guide through these times, because I still get things to my house from an explanation of benefits. I'm like, what the heck is this that I don't even understand? So I bring it in and say, hey, what is this? And you need that person that is in your pocket. That you need to be able to sleep well at night with somebody you're comfortable with.
So I get the employee training side. So it might not be as self-evident. So we got to communicate a little bit more on this topic. Train our employees, let them know that, hey, you really are participating in an awesome nationally known brand name network. How about on the claims side? So I hear it, the frustration in my wife's voice when she says, "Hey, your insurance card isn't working. What's wrong?" And it turns out it was, it was maybe the reception desk at the facility. She was, trying to, pay for a service, right, or an office visit, and they were the ones screwing things up. Is there any extra complication by, Cigna not being on the card and the TPA's name is on the card when it comes to actually presentation for payment?
I think when your wife would say to your spouse would say your insurance card is not working, there'd be a couple more adjectives in there. So
They're happy. You're correct.
so, and we've all gone through that, but
All about the words you need to.
yeah, exactly. But no, what a lot of so what it is that the cards have changed because you want to, if you're using the Cigna network or the Anthem network, that needs to be in bold and needs to be a big part of the card, and it makes it easier for the person in the front desk to understand. But it also helps if the employee comes in and says, "Hey, I know it says preferred benefit administrators, but my network is Cigna. Here it is right here." And they'll say, "Oh, okay, no problem." So that's kind of, we talk about the education process.
Got it. Okay. All right. Does the employee ever have to interface? Is the employee going to interface with the TPA at all, or are they primarily dealing with their healthcare providers and their employer? Does the TPA get involved in that mix?
They do. A lot of times with our relationships, they do if they want another card or whatever. We usually handle all that stuff for everybody. So we just have the employees come to us. But sometimes it depends on how the employer is. Like we have employers that they want all their employees to go to HR and the HR will handle it. They'll call us or they'll call the TPA, and it just depends on how they want to structure it. But a lot of times, most folks now in HR are putting on 5 different hats and just so busy and so inundated, especially in the mid market that we're talking to. In the small market, those are the folks that don't have this huge resource team put together and need help. And what you have to do is structure that help around them and let them know that easy is the way that we want to live and sleep well at night, and have the folks understand that they can come to you or they can come to, whoever it is directly, and then they'll go to the TPA or the carrier on their behalf.
Hey, Matt, so I know you're in Florida. You guys got involved. Your firm has offices all over, but we have people on this call from coast to coast here, and probably have existing relationships with their own broker that they would want to carry the conversation on. What guidance would you give everyone for how to think about working with and maybe vetting TPAs? Because I think about all the moving parts, right? I think about the employer. I think about the direct employee who has to deal with processing claims and presenting payment for healthcare services. And that should be as frictionless as possible. And when there's a TPA, which may be a known company to us in the payroll HR business benefits world, but is it a foreign concept to maybe the employer, certainly the employee? And there are, I think, I'm not overstating it, thousands of them. Right, TPAs. There's certainly hundreds. There's thousands, right?
Thousands.
So how do you, what guidance do you give a small business entrepreneur, employer that you're never going to meet? How should they be vetting and thinking about working with their broker when it comes to properly vetting and working with these TPAs?
So the TPA model, I don't think would come in till you have about 100 insured, where you would use a third-party administrator that would have the ability to use network access for the from the BUCAs. But on the converse, though, if you are looking at level funding, that looks more like the fully insured product. You still have to have a partner that you feel comfortable with, and now it's different. I've got clients everywhere, and folks just want to. Everything is virtual now, and it's just a different world. So just finding people that you're comfortable with, that are going to respond and get back to you right away, and it's just changing so much. And that's just like telemedicine is really starting to take hold. The telemedicine, being able to go on your phone and go face to face with a doctor, or be able to call a provider like that has just exploded through this whole COVID thing. I mean, the numbers are astronomical, but it's fantastic because it forced employees to realize, hey, I don't have to go to the doctor's office. We're in this virtual world right now. Now I can just go ahead and start using the doctor that I have on my phone, and I get a prescription right down the street, and it's perfect.
Yeah, right. Beautiful. All right, looking at the clock, I'm going to get to the last myth here so we can save a few minutes for some questions. So if you guys do have questions, use the GoToMeeting interface. You can go ahead and start logging them now, and that way we can take them at the end here. So the last one is not wanting to get stuck with a claim. I think that what people need to understand is what you talked about a little briefly earlier about what is run out and how does that work? How do all carriers offer it, et cetera?
Yeah, runout is what you purchase additionally for the 6 months after the contract is termed, and that helps you with any claims that would incur in the last few months that you would be able to have them, or claims were filed afterwards. It makes sure that they get paid so you don't get stuck with them.
All right. Anything else you'd want to guide people here to how to think about how they're not going to get stuck with claims?
Well, just you need to make sure that the run out is on there. A lot of times people don't ask for, or it's called TLO, terminal loss offering. So you got to make sure you ask for TLO or the run out. Same, it's a synonymous word, but just make sure that that's in the quotes and the information whenever you get it.
Got it. So maybe my kind of 2-cent recap here before we jump into some Q&A. For me, as I think about how do we help small business owners and entrepreneurs grow their business, this could be a great way to save money, right? So there's benefits is one of the biggest line items in the P&L, and there are very real, meaningful mid-single digit, maybe even double-digit cost-cutting opportunities that lie here. It may, in fact, require a little more complexity to administer because you're talking about insurance on insurance and a deeper level of understanding, but the savings potential is just simply too big. And this cost curve is not bending itself. It's going to happen from employers insisting upon the types of plans that they provide their employees, because that's how insurance works, and it's going to be market driven. So with that, just 30 seconds on Assure. We provide human capital management software, that's payroll and tax, time and attendance, HR software, and HR services to help companies grow. So no matter what type of company, what industry you are, we come at human capital management from an entrepreneur's mindset and think about it's all about finding the right people, developing the talent that gets behind your mission, your vision, your values that can help you get to the next level, and then doing so in such a way that you don't have a big IT footprint and you can conserve cash and allocate those expenses towards the thing that help grow your business rather than building a back office infrastructure. And that includes, in today's COVID world, which sure has thrown some serious complexity into the mix, HR services. So if you are not yet ready to hire a full-time HR staff, or if you want to outsource part or simply access an online database, we can be your outsourced HR function, or at least augment and support your HR function as well. So with that, Matt, I want to give you an opportunity to kind of share some contact information and explain who your firm is, and then we'll go to Q&A.
Just real quick, I mean, everybody can tell what we do here from the call. I appreciate the opportunity greatly to be on here to help you guys out. And we're available. We're a full service organization. We're the largest privately held in Florida, and we're one of the fastest growing. And I think we're up to 7th in the privately held in the country. But this is some information about us here. If you have any questions or even what ifs, just you can email me or call me, and I'm always here to help.
All right, thanks, Matt. I appreciate that. Okay, if you want to go to the Q&A portion of the GoToWebinar tool, and we will do our best to answer your questions. And I don't see any in there yet, so go ahead and pop in any questions you might have for Matt. This is not a sales pitch where we're trying to sell you our software or his services, but just any question you might have on self-insuring. Matt, any other, wait to see if any questions come in. Any other comments or things that come to mind that you'd want to share with the team?
No, I think as we said though, I think for any size company, doesn't matter how many lives you are, everybody should just look at level funding at a minimum. That's something for sure. And I would look at it from multiple carriers, not just one.
I agree. I think that is at minimum, it's the toe in the water that didn't exist a few years ago for even very, very small groups. I think you said that, 10 employees or more.
Correct.
All right, Matt, we must have killed it because there's not questions coming in. By all means, so we have recorded today's session. We're going to send everybody an email with that recording, along with contact information for Assure and for Matt's firm. So if you'd rather hop on a phone call or send an email, happy to communicate that way and answer any questions. With that, I want to thank everybody for their time. I really enjoyed today's session. Matt, I want to thank you for your time. This is a cool area that I think people don't want to insult, but I don't think everybody in the world always thinks that insurance is cool. I'm sure you do because it's your career. But this is a cool opportunity for small business owners to save real money that could then be reallocated to growth initiatives.
I appreciate you letting me on the call. And like I said, anything you need, Mike or Stacy, please let me know.
All right. Thanks, guys.